After 8 consecutive years of growth, the economy has hit a recession. Real GDP decreased 1.2%. The unemployment rate increased 5.5 to 8.5%. Inflation has stayed low at 3%. Hi, my name is Alex Lynn and I'm at the DBA. Here with me is a representative from DBA, Sean Desai. Tell me, what do you do here at DBA?
Well, what the DBA stands for is dollar bill availability. What this means is that we regulate expansionary monetary policy. How do we regulate the expansionary monetary policy? Well, we use specific tools. Do you know any of these specific tools, Alex?
Is it one of them the open market operations?
Yeah, one of them is the open market operations. In this, we either buy or sell securities. But during monetary expansionary policy, do you know what we do?
Buy, but why?
Well, we buy securities to inject money into the public so they can spend and get out there and spend more money. Another tool is the discount rate. What the discount rate is it's the interest rate banks pay to the Fed when they loaning money. And do you know what we do to the discount rate during expansionary monetary policy?
You would lower, since then the banks would want to buy more.
That's true. We lower the discount rate. The last one is the reserve requirement. What this is the money that a bank has to keep on hand. And during expansionary monetary policy, we
lower.
Yes, so that the banks can loan out more money to the public.
I'm still kind of confused. What happens in monetary expansionary policy?
Well, let me show you in simple terms with graphs. I'll start by showing you the money supply graph. What this graph shows is that the demand for money and the supply of money. And when we inject money into the economy, the supply of money goes up. And that would cause interest rates to decrease.
Wait, so when interest rates go down, doesn't it have to do with investment? So if we're here and interest rates go down, investment goes up, right, Sean?
Yes, Alex, investments would go up because of the decrease of interest rates. But do you know what happens to the aggregate demand graph?
I'm not sure, but let me go over it with you.
Well, since investments is a direct relationship with aggregate demand, when we increase investments, we are increasing aggregate demand also.
So wait, wouldn't long-run aggregate supply increase as well?
That's right, Alex. Long-run aggregate supply would also increase, which would cause output to increase and price level, also causing employment to increase and exports to go up.
But doesn't when exports go up, the dollar depreciates?
Well, that's where risk comes in. But with the help of consumers, we can eliminate this risk by spending more. Help me on this one, Alex.
Alright. There we go.
And since exports and imports are directly related to aggregate demand, if exports go up and imports go down, aggregate demand would increase also.
Oh, I understand now. I learned a lot at the DBA and how expansionary monetary policy really works if there was a recession. Do you think so?